I lost thousands learning to invest in the stock market. And with so many so-called gurus out there selling courses on information you can ultimately find free on the internet, it's even harder to get the training that you actually need. But over the last 10 years, I've created and tested a 4-phase process for making consistent profit in the stock market without sitting in front of the screen all day, and it's not complicated. Absolutely anyone with the right approach and mindset can apply this. What I want is you to skip the years of constant frustration and wasted money that I experienced to get you closer to achieving your goal of generating wealth for you and your family. This is the same system our members have used to double their accounts over the last 2 years. Okay, so the first phase of this 4-phase process, which we call the 4-phase sequence method, or the 4PS method for short, automatically filters out the very best stocks. And without this, you will continuously and frustratingly pick stocks that lose money. The whole process starts with picking the right stocks. I cannot stress that enough. Think about it like this. When you buy a car, one of the first questions you ask about is its history, including how many owners it's had, its service history, and whether it has been in any accidents. You do your due diligence. The history will tell you everything you need to know about how well the car is likely to perform after you buy it. Stocks work in precisely the same way. If a stock has a volatile past and not a very appealing history, then it's very likely going to continue to be volatile and unpredictable after you buy it. So this is why phase 1 of the 4PS method involves looking at the history and structure of past trends, and we can easily do this by looking at the monthly time frame. What we need to see are periods of consistent bullish periods over at least 12 to 18 months at the very minimum. This indicates to us that the stock has a history of continuously pushing higher and building momentum. Strong moves lead to considerable profit over the long term. So first, checking that a stock meets our phase 1 criteria means we can then move to the next phase. Okay, so phase 2 of the 4PS method is learning how to identify a stock right before its next big move. Luckily, there is an easy to spot pattern to look out for here. Think of it like this. After a marathon, runners take a while to recover. If they try to run another marathon the same day, unless they're Superman, they're very likely to struggle to build up anything like the momentum they had the first time. And the longer they rest, the better they'll recover, and so the better they'll perform in the next race. Makes absolute sense, right? A stock is exactly the same. After it runs a smooth long-term trend, which, as mentioned, is typically 12 to 18 months at the very minimum, the market will become exhausted with buyers and the momentum will eventually run out. Then you'll see the stock fluctuate sideways, bouncing between 2 price levels. This is its resting period, very similar to the marathon runner, which is called a consolidation or a range, which are just synonyms for a sideways market, which can last for a few days to months to even years. The sooner it tries to get back to trending up, the more likely it will do so with less momentum and even fail. Here's the thing. This is the phase where investors lose confidence in a stock, which is a massive mistake. Investors ask me all the time whether they should sell a stock they have purchased when it starts trading sideways. Now, I remind them that if it has performed well in the past, well, then it's very likely to eventually perform well again in the future, and really well. But the stock is resting for now, and we must allow it to rest. We cannot force things. Applying patience here is critical and is a key ingredient to the profit they are now seeing. So what we want to see is a stock moving sideways for months or years, because when a stock does this, it has the tendency to climb quickly and smoothly, generating effortless profit. That right there is crucial. This is how we catch stocks that rise over 80% after they have consolidated for a very lengthy period. Checking this off too when doing your analysis will increase your chance of investing in a very profitable stock. All you need to do is put an alert above the high of the consolidation zone, and when the stock finally breaks out, you will be notified and you'll be ready to take the next important phase. Now, these phases are outlined in our stock market blueprint and a tool our community and I use every week to find those stocks that rise 80%, even more. I'll put the link for you to download the blueprint below. Okay, so the third phase of the 4PS method is where the action is about to begin. This is where things really start getting interesting. You've placed your alert, the alert goes off, but hold your horses. You do not want to have a false start. This part is where investors get taken out. Think of it like this. They jump in too early, like a runner moving before the starting gun and ultimately getting disqualified. The result is unnecessary losses. Instead, what happens is the stock usually reverses back into consolidation and continues to move sideways for months. But where did those investors go wrong? What should they actually have been looking out for before buying into the stock? Well, the smart money investor waits a little bit longer. They apply that much underappreciated skill, patience. We wait for that extra bit of confirmation. This filter allows only the strongest performing stocks through to our portfolio. So before entering, we want to see a particular pattern called a bull flag. We need the stock to rise up slightly after the initial breakout, then pull back to touch the support level, which is the high of the consolidation zone, then bounce from this level and break above the previous high. This simple filtration process confirms the buyers are in control, because when a stock forms a bull flag pattern, it is more than likely to consistently soar to new heights. So patience ultimately pays off. Okay, so you know that moment when everything finally clicks? You've waited, you've planned, you've stuck to your system, and now the stock is moving, the profit is rolling in, and it finally feels like all the effort is paying off. But with that comes a new kind of pressure. When do you get out? Exit too soon and you feel like you've sabotaged yourself. Exit too late and, well, you're giving all the hard-earned profit right back. This is where a lot of investors start second guessing their instincts. They'll look at small red candles and think that's it, it's over, and rush to exit, only to watch the stock climb another 80% and without them. Or they'll cling to a position out of pride, watching it fall day after day, convinced it's just a dip until it becomes a loss. A lot of the mistakes come from misreading signals. One person sees a red day and panics. Another sees a failed breakout and tells themselves it's just noise. But these aren't signals. They're emotional reactions dressed up as logic. Now, imagine instead you're using a trailing stop loss, specifically something like a Donchian channel, which I have highlighted on the screen right here, this red dotted line below price action. Instead of making emotional decisions in real time, you've already defined how far you will allow the stock price to decline before you exit. The Donchian channel follows the stock price at a safe distance. You can see the distance between the stock price and the Donchian channel, locking in gains as it climbs. And when the trend comes to an end by breaking the Donchian channel, you're out. Not because of fear or hope, but because your system told you to. Now, let's say you purchase this stock that I have on screen right here, ticker symbol FI, Fiserv, and it moves up in your favor after you purchase it. But fear gets the better of you during this particular correction and you exit early for a tiny profit. But the stock actually continues rising by another 30%. With a trailing stop loss like a Donchian channel, you would have stayed in until the full move played out, exiting with more profit. Or maybe you purchased United Healthcare, ticker symbol UNH, and accumulated very, very good profit, but it started to reverse. You hesitate, thinking it will recover, and you ultimately give back half of your profit before finally exiting. The Donchian channel would have caught the turn early and you would have preserved your gains. This tool isn't magic, but it is precise and more importantly, it is objective and it takes the emotion out of your exit, which means more of your gains actually make it into your account. And all these rules must be clearly laid out in your investing plan, so you know precisely how you will manage a stock investment from entry to exit with clarity and composure. No emotions at all. As the saying goes, plan your trade, trade your plan. I mentioned earlier that without knowing how to filter out the best stocks, you will end up picking a stock that loses you money. But there is something that I help my members implement that will not only find you profitable stocks, but help you do it in just 3 seconds. So check out this next video where I show you what the phases are so you can start using it right away.